Hey everybody, this is Jason Matthews, President CEO of Matthews Financial Insurance Solutions, along with being President CEO of Gibson Monroe Wealth Advisors. So right now, yesterday, we had huge news about Silicon Valley Bank and how the bank got taken over. Along with being President CEO. And so with that, I know this morning I had a lot of people ask me questions. So I came to the office this evening when I had a break. I said I was going to get on 5:30. So I do apologize about that. But what I wanted to do is get on, explaining to everybody what's happening with Silicon Valley Bank, for you guys can make the best decisions for you, your family, your business, and your community overall. So let me go ahead. I made a quick PowerPoint to explain it, as I think this is a very, very, very fascinating story about Silicon Valley Bank, and for lessons for all of us to have regarding banking and regarding what's happening and how I see the economy about it. And I think this is something everybody should really pay attention to right now, because it's a very, very, very important topic right now. So let's really dive into what happened to Silicon Valley Bank, right? So when I talk about this, I made a quick agenda for this meeting on a Saturday night, because I think this is very helpful right now this evening for about this situation, because things are going every day. We're going to continue to hear news about Silicon Valley Bank. So I'm going to talk about who is Silicon Valley Bank, what happened, what's next for them, the ripple effects, and last but not least, the lessons we all can get from it. So Silicon Valley Bank is a bank based out of Silicon Valley, and that's where the name comes from. Is known for the relationships in the tech for tech startups, venture capital. Was really known for that, as it was really good for building relationships with them. Oftentimes, as a small business owner, as a small business, it's hard for you to get funding and capital for your business, and hard for banks to want to give you money. If you go to your traditional big four banks, your Wells, your Bank of America, your Citigroup, you're not used in Chase. Usually they won't give you money as a startup. They might not give money for your capital for your business. They might not give you money for your home loan, because they usually want to invest with a business that's usually more established. There's an old saying that banks don't lend you money till you actually don't need money. So Silicon Valley Bank was different. It was a bank where you could actually go and you could turn in and work and get that capital that you might need. And because of that, they were the 16th largest bank in the United States. And 50% of their loan portfolio was venture capital firms and private equity firms. And what usually happened a lot of times was that if you got investment dollars from a private equity firm or a venture capital firm, they say, hey, you have to bank with Silicon Valley Bank because we have that relationship with them. So that's an important thing to know. So what happened? All right. So first of all, what happened was we have to go back. I think this is a very elaborate story. I think this could be made into a movie about all the movie parts of everything that happened within the last week. But I'm going to go deeper into that and go back a little bit further to what really happened in 2008 to get us here. So in 2008, we had this financial crisis. And with that financial crisis, if you guys remember, was that we had the housing market, which caused a Great Recession. In response to the Great Recession, the Federal Reserve lowered rates to historically low interest rates, very, very low interest rates. And at the same time, when they lowered those interest rates, what you saw was it would start becoming a boom here in the Bay Area, more importantly, Silicon Valley, where we had tons of startups, your Ubers, your Lyfts, Uber, Lyft, Airbnb, and all these startups. And that happened because it was in a 0% interest rate environment. I always say it was the era of free money. And because of that, banks oftentimes what they were doing was venture capital firms and private equity firms was borrow money from these banks. In return, these banks were getting a lot of deposits in Silicon Valley Bank was. And when they were getting those deposits, they were getting the money at very low interest rates. And banks are not supposed to put their money in any type of crazy place. Where they have to put the money in a lot of times are in treasuries, fixed income, safe assets. And then as you can see in this picture, there were very low rates. And from 2009 during the market all the way up until 2022. Now, there was a period of rates where it went up. So, that's what's happening in interest rates. At the same time, what we've been having since these low interest rates of 08, 09 was that now we're going through a turbulent times in our economy right now, right? Very volatile due to inflation. We see it when we buy eggs. We see it with the mortgage rates on. We buy eggs. We see it with gas, food, and all aspects of our lives. We are seeing inflation. But due to that inflation, what the Federal Reserve is trying to do is counter inflation by raising interest rates. And when you raise interest rates, it has hurt tech more than any other group of it. So in 2020, when COVID first hit, I want to say 2021, I should say, people were investing in Carvana, Peloton, and Beyond Meat, and all these tech firms before, and they were doing great. But since that period, a lot of tech firms been getting killed as well. And because of a lot of tech firms, these are just a few companies were getting killed. What they start doing, instead of keep borrowing and borrowing and borrowing money, because now venture capital firms were not giving them money no more angels and all this free money because of higher interest rates. They start taking money out of their deposits because of that. So the money they had in the bank, they start taking out of it. And because they were taking money out of it, Silicon Valley Bank was like, oh, shoot, they keep taking deposits out. And if you know anything about banking, banks do not keep all your cash. They invest it. They give out that money and let other people borrow those funds. So when everybody starts taking money out of the bank, now they're in trouble because they cannot give all that cash. They never have all the cash on hand because they're investing so much of it. So in return, what happened at that point was they need to raise capital. And the way that they need to raise capital was that they need to sell some of their bonds portfolios. But one thing that happens in bonds is this. As interest rates rise, bond prices fall. And so here's the reason why. Let's say right now you have a bond and you got a bond for $100 and you're getting a 4% interest rate, which is great, right? I get $4 on $100 every single year. But let's say if interest rates rise, so now interest rates is I can get a brand new bond at $7 or $8. I'm not going to buy your old bond at $4. I'm not going to pay $100 for your $4 bond. So what I'm going to have to do is, instead of doing that, I'm going to have to lower the price of my bond. Now, I don't lose anything until I have to sell it. Even though interest rates have risen, the value of my bond dropped, but I don't really realize those losses until I actually have to sell my bond. So Wednesday happened, right? And as we have interest rates rise because the Federal Reserve was trying to fight inflation, they was in trouble. So what happened last week was the Silicon Valley Bank had to sell their bonds that were at historical lows. They sold $21 billion because people was taking cash out of the bank because of deposits. And they took a $1.8 billion loss because of the sale of their bonds because they had to. Even though interest rates were higher now, oftentimes you might hold on to those bonds because you know that you cannot, if you sell it, you're going to sell it at a loss. But Silicon Valley had to sell it at a loss because they need to show people that they had the cash for it. So people saw that, they were startled. Then you start having venture capitalist firms and everybody advising people, hey, you really want to take out your money. And the most famous person to do that was Peter Thiel, the legendary person in Silicon Valley, was telling people to do that. So even on Wednesday, they sold for $21 billion. They sold $21 billion worth of bonds. Thursday, now instead of selling bonds, now it's getting really, really in trouble. And they had to sell $2.25 billion in stocks to get capital. Their stock price dropped 60% on Thursday because of that. Now, Thursday, we're hearing this noise about, hey, they sold their bonds. They don't have the capital. So, hey, get your money out of the bank. And Silicon Valley knew they were in trouble, right, as it was happening. So what they were trying to do was possibly sell their bank to other institutions. But unfortunately, before they were able to sell it to other institutions and find alternative funding to possibly sell the business, the FDIC, right, the Federal Depository Institution Corporation, took them into receivership. So now Silicon Valley on Friday got taken over by the FDIC. So now let's talk about what happens next. So right now, anybody who has deposits of less than 250,000 will be able to touch that money on Monday and have access to that capital, which is great. But the thing about Silicon Valley Bank, as I told you, this was a bank for private equity firms, venture capital, startups. So oftentimes these businesses and individuals have a lot more than 250,000 deposits. So with Silicon Valley Bank, only 10% of them, actually only 10% of all deposits was less than 250,000. Now, accounts above that, don't have access to them, don't have access to those funds. And they're waiting right now to find out what they're going to do. You have a lot of corporations who had a lot of cash with them, and they're trying to see how they're going to be able to get some of that cash. But unfortunately, they can't do it because, remember, anything over 250,000 is uninsured. But here's a good thing. One thing is, we're looking at it, and the FDIC did their job. They're taking over these banks, they're making it smooth, and they're helping out the people that they say within their promise. So the government programs and institutions we have did their job on that part. But the part that they did not do was they didn't do proper oversight to understand the fundamentals and the financials of Silicon Valley Bank so we don't have this situation happen. So because of this, we have 27 major companies are affected that we hear about. Roku had over $400 million with them. Vimeo, Roblox, Bazinga, Sunrun, right? Shimmerx. These are just a few of the companies that have been affected because of this whole thing with Silicon Valley Bank. And there's might be even more companies that might be affected from it. But so since then, what we're seeing, what we want to see right now is the ripple effects. So right now, when that happened on Friday, most regional banks' stock values dropped. Because now what everybody want to do is look at seeing, is there another bank who's in the same situation as Silicon Valley Bank? Or is this just a one-off? I think right now there's issues with First Republic Bank. There's rumors about them, and they took a huge hit. But right now, we're still seeing what's going to be the ripple effects. We might not find out this week, but like I heard some people when I was watching Bloomberg saying, we might not find out about the 12 to 16 months for this. Also, the next ripple effects is the FDIC is looking to see if any bank would like to purchase Silicon Valley Bank assets. So what usually happens is the FDIC takes over the bank and manages it, makes sure it's running smoothly as they find another purchaser of Silicon Valley Bank. That might be one of the big four banks: JP Morgan Chase, Wells Fargo, Citigroup, or B of A. We simply don't know. But also, I think a ripple effect is going to be there. It's going to be harder for funding for startups. I think in the next 12 to 18 months, funding for startups is going to get a lot more tighter than we were in that period of time. I think this just shows you the ripple effect of the era of free money that's been over with. And I don't think we're going back to that anytime soon. We could actually see rumors just saying Jerome Powell is going to raise interest rates another 25 to 50 basis points his next meeting. So I think we're going to be in this for a while. I think this is just one of the first casualty awards. And not even the first one. There was also another bank that folded the day before, Silver something bank, but they invested highly in the crypto space, and with the crypto collapse, they collapsed as well. So what are the lessons? First of all, diversification is important, right? So even when we're doing our own investment as an individual, we shouldn't put all our eggs in one basket. We should stay diverse. We should diversify our portfolio, not just buying one individual stock. I think this is a lesson that we should all have. If you're a business, you always say is you don't want to make your business based off of one customer who is 50% or 80%, 50 or 80% of your book of business. So it's important to stay diversified and diversify as well. Diversify your stock portfolio within your business and who you work with as your clients. Also, a thing is you should also stay diversified in your banking relationships. Oftentimes, you might just bank at B of A or Chase or any just one bank. But diversity is so important with having money in different banks, just in case something happens like this. So when I talk about Roku, how they lost $487 million, it's trapped right now in Silicon Valley. They say they still have enough money for payroll because that was only 25% of the cash they had on hand. So that tells you they have money at other institutions, and you should do the same thing for yourself as well. Another lesson is cash is still king. I think their free money era, everybody was leveraging themselves, taking on a huge amounts of debt. But we have to realize now is that cash is still king. Cash is king, and we have to be mindful that cash is king. And we could take we could take advantage of that period of time when people need cash. I was here listening to how one person on Bloomberg said a lot of companies going to be having trouble making payroll, right? Doing business operations, just paying their bills. You will see people what they call grave dancing, vultures who want to take advantage of the situation for companies who don't have the capital right now, but still need to make payroll. They might have to give up a lot of their equity, some of their profits, and get into some bad deals because of that. And the last thing is, we're not just seeing the effects. This is just the effects of saying the free money era is over with. I hope you guys take this information. I hope this helps you guys out. If you guys need anything from us, make sure, I'm doing this on a Saturday, just a quick thing on a Saturday night while it's free. But I also want to just give you guys information about what's happening. If you guys do, the news is going to keep talking about this. And I think this is going to keep unwinding for a period of time. If you guys ever have any questions, give us a call in my office at 510-288-3268. I would love to hear your guys' comments and how you guys feel about this. I think this would be really, really good. Thank you guys so much.